Welcome to the Deep Dive.
Great to be here.
Today, we're tackling the big questions swirling around the U.S. economy. It's a complex picture right now.
Absolutely. Lots of moving parts.
Yeah, and we've got a really interesting mix of sources. Forbes, Newsweek, Bloomberg, Reuters, CNN, Politico, even a speech from Federal Reserve Governor Michael Barr.
A wide range, definitely, covering different angles.
Exactly. And our mission really is to pull out the key pieces from all this info, synthesize it, and give you a clear understanding of what's happening.
Yeah, make sense of the indicators, the expert takes, what might be coming down the pike without getting lost in the weeds.
Right. So let's unpack this. Where do we start? Maybe with the R word, recession.
Okay, yeah, that seems central. So first, there's the definition thing. It gets a bit tricky.
Right, the technical definition people throw around.
Yeah, that's the 2 straight quarters of negative GDP growth. And while the U.S. did just log its first negative quarter since 2022.
Okay, so one down. But that's not the whole story.
No, not quite. The official call comes from the National Bureau of Economic Research, the NBER.
And they look at it differently.
They take a broader view. They're looking for, and this is their phrase, a significant decline in economic activity that is spread across the economy and lasts more than a few months.
Spread out and lasting. So one bad quarter isn't automatically it if things bounce back.
Precisely. It needs depth and duration.
Got it. Okay, so with that context, what are the forecasts saying? Are the experts worried?
Well, yes and no. It's really varied. Goldman Sachs, for instance, they're putting the probability of a recession in the next 12 months at 45%.
45%, that's pretty significant.
It is. And they're specifically highlighting what they call event-driven downturn risks. Think tariffs, geopolitical stuff.
Okay, but not everyone agrees.
Not at all. UBS Wealth Management, they're actually more optimistic. They think the U.S. might just skirt a full recession.
And why is that?
They're banking on potential trade deals happening, maybe some tariff reductions easing the pressure.
Interesting contrast. And it gets even sharper, right?
Oh, yeah. You look at the chief economist over at Apollo Global Management, he's sounding a much louder alarm.
How loud?
90% probability, 9-0. He calls it a voluntary trade reset recession.
Wow. And he's blaming trade policy directly.
Pretty much. He sees current strategies as ineffective and, well, recession-inducing.
A voluntary trade reset recession. That's a memorable phrase. And other banks, where do they land?
Still kind of all over the map. Bank of America hasn't put out a number quite like that, but Morgan Stanley is around 40%, JP Morgan Chase maybe 60%.
So lots of disagreement among the big players.
Yeah.
Everyone reading the tea leaves differently.
Exactly. Which brings up that crucial question. What signals should you be watching most closely right now?
Yeah, what's driving these different views? Is it the data?
Partly, but also interpretation. Look at Larry Summers, former Treasury Secretary. He's quite pessimistic.
What's his take?
He thinks it's 6 in 10 or better that a recession starts this year.
More likely than not, then. And the potential impact.
He paints a pretty stark picture. Maybe 2 million more unemployed Americans. Average household income potentially dropping by over $5,000.
Oof, that's a significant hit.
It is. And it's a very different story than, say, what you hear from Trump administration officials.
Right. They're saying the data doesn't support a recession call.
Correct. They're pointing to other indicators, arguing things are fundamentally sound.
Okay, so major disagreement at the top. What about the average person? Consumer confidence.
That's where things look less rosy. The Conference Board survey, it fell to its lowest point since 2020.
Since the pandemic hit. Wow.
And the University of Michigan's Consumer Sentiment Survey had its biggest 3-month drop between January and April since way back in 1990.
1990. That's telling. People are feeling nervous.
Seems that way. But here's the puzzle.
There's always a puzzle.
Right. How people feel versus how they act. Look at consumer spending. March retail sales. They actually grew by 1.4% month over month.
Better than expected.
Yeah, beat economists' projections. So people might be saying they're worried, but they were still, buying things.
That disconnect is fascinating. Feeling glum, but spending anyway.
It's one of the key things economists are wrestling with. What does it mean?
Okay, any other indicators, flashing signals? What about that SAM rule I've heard about?
Yes, the SAM rule. It's a neat one, developed by economist Claudia Sam.
How does it work?
It looks at the unemployment rate's 3-month average. If that average rises by half a percentage point compared to its low over the previous 12 months,
then a recession is likely.
Historically, yes, it's been a very reliable indicator, but right now, we're not there.
We haven't hit that trigger point.
No. Current readings are actually below the peak unemployment rate we saw last summer.
Okay, so that's one signal maybe for the no recession yet camp.
Yeah.
But clearly lots of caution flags elsewhere.
Absolutely. Which leads us nicely into tariffs and trade. That seems to be a major source of the uncertainty.
Definitely feels like it. President Trump's announcement back in April.
Hmm.
These reciprocal tariffs.
Right. That caused quite a stir in the markets. Remember, a lot of them got paused just a week later after a big sell-off.
But not all of them went away.
No, some pretty significant ones are still in place. On goods from Canada, Mexico, cars, and that huge 145% tariff on China.
145%. And China hit back, didn't they?
Oh, yes. Retaliatory tariffs of 125% on most U.S. imports. Classic trade war escalation.
And the basic economic impact. Tariffs generally mean a higher trade deficit, which drags down GDP growth.
That's the standard effect, yes. Imports become more expensive. Exports potentially face retaliation. It subtracts from the GDP calculation.
But there's some talk of this easing up. You mentioned Goldman Sachs earlier.
Yeah, that's an interesting forecast. Goldman actually expects U.S. tariffs on China to drop significantly from around, 160% down to maybe 60% relatively soon.
60% is still high, but much lower than 160.
Exactly. And they think China would likely respond in kind, lowering their tariffs on the U.S. too.
So a potential de-escalation.
Potentially. Though Goldman still notes that even at 60%, it's an economic headwind, just less severe.
And are there actual talks happening?
Yes, right now, actually. Treasury Secretary Scott Bessent and Jameson Greer, the chief trade negotiator, they're meeting with China's top economic official in Switzerland this weekend.
For de-escalation talks.
That's the stated goal. But China's position seems to be firm. They've said the U.S. needs to stop the threatening posture for a deal to happen.
Okay. So diplomacy is happening, but the outcome is uncertain.
Very much so. And this whole situation, the unpredictability, it's affecting how the U.S. is seen globally.
As a trading partner.
Yeah, concerns about reliability. There was a Politico Public First poll recently. It found a plurality of adults in the UK actually think China would be a more reliable trading partner right now than the U.S.
Wow. That's a significant finding, perception-wise.
It really is. Now, despite that general unease, there was a U.S.-UK trade deal announced.
Right, I saw that. Lowering tariffs on some specific things.
Yeah, British cars, plane parts, steel, aluminum, and opening the UK market a bit more for some U.S. agricultural products.
So some progress on that front.
Yes, but even there you see skepticism. Polls suggest people aren't totally convinced Trump will stick to this deal long term, given past action.
That predictability issue again. Lingering doubts.
Exactly. And you see the real-world fallout for companies. Like Shine, the online fashion retailer.
What happened there?
They apparently had to hike their U.S. prices to cover the increased tariffs, and boom, U.S. sales dropped by 23% in late April, early May.
A direct hit to the bottom line.
For sure. And BMW is another example, facing weaker demand in China and the U.S., plus the U.S. tariffs are adding to their challenges.
So these aren't just abstract policy debates, real companies, real impacts.
Absolutely. Which brings us to the Federal Reserve. What are they doing amidst all this uncertainty?
Good question. They just had a meeting, right? May 7th.
They did. And they decided to hold interest rates steady. No change.
But what did they say? Did they acknowledge the risks?
Oh, definitely. Their statement specifically mentioned that the risks of higher unemployment and higher inflation have risen.
Uh-oh. That sounds like stagflation concerns.
That's the worry. Slow growth, rising prices, rising unemployment. It's a very tough scenario for policymakers.
And did Chairman Powell talk about the trade situation?
He did. He really emphasized the uncertainty that Trump's trade policies are creating for the economy and for Fed policy itself.
So the Fed feels kind of stuck.
They're basically in that wait-and-see mode we talked about, trying to figure out the actual impact of these tariffs before making a move. Powell said the current policy rate is in a good place to stay for now.
Even with President Trump calling for lower rates.
Powell pushed back on that, denying any political influence. He stressed they focus solely on the economic data and the outlook.
Maintaining independence, okay.
Right. And interestingly, the Fed does expect tariffs to push prices higher. The big questions for them are how much higher and for how long.
And how will they know if things are getting bad enough to cut rates, say?
They said they'd look at a huge array of labor market data. They need to see clear signs of deterioration before acting.
And this uncertainty, it's affecting businesses beyond just tariffs.
Yeah.
investment decisions.
Yeah, that's a key point. Some businesses are apparently postponing investment plans because they just don't know what's coming next with trade policy.
Holding back on spending.
Exactly. And some have even withdrawn their financial forecast for 2025 altogether. That kind of hesitancy, it definitely acts as a brake on the economy.
Okay, let's pivot to that labor market data the Fed is watching so closely. What's the picture there?
Well, on the surface, it still looked pretty resilient, surprisingly so, perhaps.
Like the unemployment rate?
Yeah, in April it was 4.2%. That's still within what's considered a healthy historic range.
And job growth.
Employers actually added more jobs than forecast in April. I think CNN reported about 177,000.
So, okay, that sounds positive against the backdrop of recession fears.
It does, but there are some underlying currents to watch. Goldman Sachs, for example, they still forecast unemployment rising to 4.7% by the end of this year.
So they see weakness ahead.
Seems so. And also, that overall rate masks differences. Youth unemployment for ages 16 to 24, that's quite a bit higher, hovering just under 10%.
Okay, so not uniformly strong. And what about layoffs? Are companies cutting back?
That's another concerning signal. Challenger, Gray, and Christmas, they track corporate layoffs. They reported a massive 93% surge in announced job cuts in the first quarter.
93% surge. Wow. Compared to when?
Compared to the previous quarter, I believe. And it wasn't just one sector. It included federal government jobs and tech layoffs, too.
So hiring in some areas, but significant cuts in others. A mixed bag.
Very mixed. And this uncertainty is really hitting new college grads hard, the class of 2025.
How so? They're feeling pessimistic.
Yeah, reports suggest they're worried about finding good jobs, blaming the general economic uncertainty, the tariff impacts on businesses, even federal funding freezes for higher ed.
And are polls backing that up?
Yes. A College Pulse Newsweek poll showed confidence dropping. In mid-April, 39% of students felt unconfident about getting the job they wanted after graduation. That was up from 33% back in January.
That's a significant jump in just a few months.
It is. And anecdotally, we're hearing about some companies actually rescinding job offers already made to recent grads.
Pulling back offers, that really signals nervousness.
It definitely does. Now, it's not all doom and gloom. Demand is still really high for grads in specific high-skill fields.
Like what?
Think data science, cybersecurity, AI, finance, computer science, accounting. Those areas seem robust.
Okay, so specialization matters more than ever.
It seems that way. But overall hiring projections for the class of 2025, they've cooled significantly, expected to be almost flat compared to last year's class.
Flat isn't great if the economy needs growth.
Exactly. And some data, like from Gusto, suggests the average hiring rate for May and June grads this year could be way down, like 44% lower than 2022, and down 16% just from last year.
Ouch. A tougher market for sure.
Yeah, definitely a tougher entry point for many young people.
Okay, let's shift gears a bit. You mentioned AI demand being strong. That brings up the bigger picture of artificial intelligence and its potential impact. We have that speech from Fed Governor Barr.
Right, Governor Barr's speech. He was looking at how AI, especially generative AI, might transform the labor market.
And what did he see? Is it all robots taking jobs?
Well, he outlined two main possibilities. One he called gradual adoption.
Okay, what's that look like?
In that scenario, AI comes in more slowly. Jobs mostly remain plentiful, wages rise with productivity gains, employment stays high. The main challenge is retraining people for new skills.
So evolution, not revolution. What's the other scenario?
He called that one transformation. That's where AI brings really profound changes to how we work.
More disruptive.
Potentially, yes. Could lead to mass unemployment in some areas. But he also noted it could free up huge societal resources if managed well. It's a big unknown.
Two very different futures. Did he talk about inequality? AI helping some workers more than others?
He did. He raised the concern about skill-biased technological change.
Meaning?
Meaning AI could primarily benefit highly educated workers, those whose skills complement the technology, potentially widening the wage gap between them and less skilled workers.
We've seen that pattern before with technology, haven't we?
We have. Think about computers. Governor Barr also stressed that monetary policymakers, like the Fed, will need to watch how AI affects the natural rate of unemployment, or U-star.
That's the unemployment rate that doesn't spark inflation.
Basically, yes. If AI significantly changes productivity or labor dynamics, that rate could shift, impacting Fed policy.
So how do we track this? How do we know which path we're on, gradual or transformative?
Governor Barr suggested key indicators to watch. Things like how fast are businesses actually adopting AI? How quickly are the capabilities improving?
Makes sense. What else?
Looking closely at job opening data, what kinds of jobs are being posted, what skills are in demand, and tracking job growth or decline by specific occupations and industries.
So watching the real-world data unfold.
Exactly. Those signals will tell us how AI is really reshaping work.
Okay, fascinating stuff. Let's quickly touch on some company-specific news that ties into these broader themes. Novo Nordisk. Their stock went up even though earnings missed.
Yeah, that was interesting. Analysts seem to think the slightly lower earnings for Wegovy, their obesity drug, were already priced in by the market.
So investors were looking past?
Apparently,
Yeah.
focusing more on the huge long-term market potential, a new deal they struck with CVS Health, and maybe less competition coming online than previously feared.
So future prospects outweighed the current numbers.
Seems that way. Then you had AMD, Advanced Micro Devices.
The chip maker. Their stock recovered after a dip.
Yeah, there was weakness initially tied to restrictions on sales to China, but the CEO came out highlighting really strong demand in the AI sector.
AI again, driving growth.
Definitely a key theme. And Disney's earnings are coming up soon. People will be watching closely.
What are they looking for there?
Commentary on theme parks, they're sensitive to economic health and progress on making their streaming services profitable.
And the trade angle. Any potential impact?
There's that wild card suggestion from President Trump about a possible 100% tariff on films not made in the U.S. Huge uncertainty there for companies like Disney.
Wow, yeah, they've also been cutting costs on content, right?
They have, so investors will want to hear about the impact of that too.
And lastly, Uber.
Yeah, their robotic partnership with Alphabet, Google's parent company, is getting attention ahead of their earnings report. Another example of tech innovation and collaboration.
Oh, okay, a lot to digest there.
Definitely. So maybe to wrap up the main takeaways from this deep dive,
Yeah, let's summarize.
it feels like the U.S. economy is really at a crossroads, facing significant uncertainty. A lot of that seems driven by trade policy shifts and tensions.
Raising those concerns about a potential slowdown, maybe even stagflation.
Right. And while the labor market has shown some surprising resilience overall,
The picture for new grads looks tougher, and layoff numbers are up.
exactly, the Fed is clearly cautious, adopting that wait-and-see stance.
And then layered on top of all that immediate uncertainty is the longer-term question of AI's impact on jobs and the economy.
It's a complex mix of short-term risks and long-term transformations.
Okay, so for our listeners, here's a final thought to chew on. We talked about all these conflicting signals, strong-ish job data here, falling consumer confidence there, wildly different recession predictions. So the question for you is, what single piece of information, what single indicator do you think will ultimately be the most reliable sign of where the economy is actually heading in the next few months? And why that one?
That's a great question. What do you anchor to?
Yeah. And maybe thinking about that, what actions might you consider taking based on how you interpret these economic crosscurrents? Something to mull over. Thanks for joining us for this deep dive.
Thanks for having me.